What if the next financial crisis has already begun? Not in the headlines, not in a dramatic stock market crash, not in a sudden collapse of banks, but quietly, gradually, almost invisibly. Because here's the uncomfortable truth. Financial crises don't start when things go wrong. They start when everything feels right, when markets are calm, when growth looks stable, when confidence is high. That's when the seeds are planted. So why do crises always seem to catch us off guard? Why do experts miss them, even when the warning signs are there? Why do economies that appear strong suddenly collapse under pressure? And most importantly, why do these crises keep repeating across decades? Too unsweared that you have to stop thinking like a consumer, or even an investor, and start thinking like a macroeconomist. Because from that perspective, a financial crisis isn't an accident. It's a process, a slow buildup of hidden risks driven by incentives. And once you understand that process, you begin to see that the real mystery isn't why crises happen, it's why we keep walking into them. Modern economies are built on credit, borrowing, lending, leveraging. At its core, credit is simple. You take resources from the future and use them today. A business borrows to expand. A family borrows to buy a home. A government borrows to fund growth. In theory, it works beautifully. But here's the twist. Credit doesn't just amplify growth. It amplifies everything. Good decisions become very profitable. Bad decisions become very destructive. And when credit expands too quickly, it starts to distort reality. Prices rise not because of real value, but because money is easier to access. Risk feels lower not because it is, but because losses haven't happened yet. The system begins to depend on continuous expansion. Debt needs to grow to sustain existing debt. Asset prices need to rise to justify previous investments. Confidence needs to remain high. And once that dependence forms, the system becomes fragile. Every financial crisis has an origin story, but it rarely looks like a crisis at the beginning. It looks like opportunity. New markets open. New technologies emerge. New financial instruments are created. There's excitement, innovation, optimism. Investors see potential returns. Banks see lending opportunities. Governments see economic growth. And gradually, credit expands. At first, it's manageable, but then competition increases. Lenders want to grow faster. Investors want higher returns, and standards begin to loosen. Loans are given to riskier borrowers. Financial products become more complex. Risk doesn't disappear. It gets redistributed, and often hidden. Through securitization and layered structures, risk moves through the system. It becomes harder to trace, harder to understand, harder to measure. As credit expands, asset prices begin to rise. Housing, stocks, commodities. Higher prices attract more investors, creating a feedback loop. Rising prices justify more borrowing. More borrowing fuels further price increases, and suddenly, growth accelerates. But not all growth is equal. In a financial bubble, growth is driven by leverage, borrowed money inflating asset values. This kind of growth looks impressive, but it's fragile. If credit slows, growth slows. If credit stops, the system destabilizes. And yet, during the rise phase, very few people question it. When everyone is making money, caution feels like a mistake. Financial crises don't require a massive shock. They require a trigger. Something small. A slight increase in interest rates. A decline in asset prices. Individually, these shouldn't cause a collapse. But with leverage, they can. When debt levels are high, even small changes can create large effects. Borrowers struggle to repay. Investors reassess risk. Lenders pull back. And once confidence begins to crack, the feedback loop reverses. Falling prices trigger selling. Selling pushes prices lower. Losses reduce confidence. Liquidity disappears. Assets that seemed valuable become difficult to sell. Financial institutions face pressure. The system reveals itself as unstable. When a financial crisis hits, the effects ripple through the entire economy. Banks reduce lending, businesses cut investment, unemployment rises, but the impact is not evenly distributed. Some lose jobs, others lose savings. Meanwhile, certain institutions may receive support. This creates a paradox. The system that created the crisis is often the system that gets rescued. Why? Because of systemic risk. When large institutions fail, they can take the entire economy down with them. So governments and central banks step in to prevent collapse. But these interventions come with consequences. They shift risk from the private sector to the public. They reinforce behaviors that led to the crisis. After every crisis, reforms are introduced. For a while, the system becomes more stable. But then innovation returns. New financial products emerge. Regulations designed for the last crisis don't fully address the next one. Each crisis is different on the surface, but similar at its core. The fundamental issue isn't just regulation. It's the tension between stability and growth. Stricter rules reduce risk, but they can also limit expansion. Now look at the present. Global debt levels are at historic highs. Interest rates have begun to shift. Asset prices have experienced rapid growth. Technology has transformed financial markets, digital assets, algorithmic trading. Through a macroeconomic lens, it reveals familiar patterns. Strong dependence on liquidity. Compressed risk perception. Global interconnection means crises today can evolve faster than ever before. At the center of every financial crisis is human behavior. Optimism during booms, fear during downturns, herd behavior over confidence. These patterns repeat because human psychology doesn't change. People assume stability will continue. They underestimate risk during good times. So what does thinking like a macroeconomist actually give you? It gives you perspective. You look at systemic patterns instead of individual events. You begin to see crises not as isolated disasters, but as the result of interacting variables over time. Debt, interest rates, incentives, expectations. Financial crises are built, not triggered. The trigger may be small, but the buildup is long. Stability can be deceptive. If we understand how financial crises happen, why can't we prevent them? Is it a failure of policy or a reflection of human nature? Maybe that's the real lesson. Not that crises can be eliminated, but that they are part of the system itself. Stay curious, keep questioning, and keep thinking like an economist. Because the more you understand those forces, the less surprising the outcomes become.